Every year, on the 5th of April, something quietly expensive happens to you. The UK tax year ends. And if you actually sit down and work out what you handed over, the number is brutal. For the average British worker, you spend the first 4 to 5 months of every single year working entirely for the taxman. From the moment your January payslip lands, right through to the back end of spring, almost every pound you earn doesn't go to your rent, your savings, or your future. It goes straight to His Majesty's Revenue and Customs. You never see it. It disappears before it ever touches your bank account. Now here's the part nobody tells you. A huge chunk of that money is completely optional, not in some dodgy, offshore, knock on my door at 6 in the morning way. Legally, openly, using rules that the government itself wrote, published, and is quietly begging you to use. So today, we're going to walk through exactly how the everyday Brit keeps thousands more of their own money the right way. Let's start by reframing the whole game. Most people treat tax like a fine, a punishment for the crime of earning a living, but that's the wrong mental model entirely. Tax is a set of rules, and buried inside those rules are dozens of deliberate incentives. The state cannot afford to look after everyone in retirement. It cannot fund every rainy day, so it bribes you to do it yourself. Every time you use a pension, an ISA, or an allowance, you are taking a burden off the government, and they reward you for it with tax relief. The wealthy understand this instinctively. They don't see the tax code as a wall, they see it as a map. So let's read the map. For the 2025 to 2026 year, the first £12,570 you earn is completely tax-free. That's your personal allowance, and it has been frozen at that exact figure for years now, which quietly drags more of us into higher tax. Above that, you pay the basic rate of 20%, all the way up to £50,270. Cross that line, and the higher rate of 40% kicks in on every pound after it. But there's a trap hidden in the system that catches thousands of ambitious earners every year, and almost nobody sees it coming. It lives between £100,000 and £125,140. In that band, something strange happens. For every £2 you earn over £100,000, the government strips away £1 of your tax-free personal allowance. So you're paying 40% on the new income, and you're losing your tax-free allowance at the same time. Stack those together, and your real effective tax rate inside that band is 60%. 60. For every extra £100 you earn there, you keep just 40. It is, without exaggeration, one of the worst deals in British finance, and we'll come back to how you escape it. So how do you fight back? You start with the single most powerful legal tax shelter available to the everyday Brit, the ISA. Think of it as a force field you wrap around your money. Every year you're allowed to put up to £20,000 into an ISA, and once it's inside, the magic begins. Any interest you earn, tax-free. Any dividends, tax-free. Any growth when you sell your investments, tax-free. There's no capital gains tax, no income tax, no dividend tax, ever. A regular savings or investment account outside this shield gets taxed at every turn. Inside the ISA, the Exchequer simply cannot touch it. The catch, and it's an important one, is that the £20,000 limit does not roll over, miss a year, and that allowance is gone for good, which is exactly why the disciplined money mind feeds it every single year, without fail. But if the ISA is your shield, the pension is your sword. And this, right here, is the turning point of the whole strategy. When you put money into a pension, whether that's a workplace scheme, salary sacrifice, or a self-invested personal pension, which we say as a SIP, the government tops up your contribution with the tax you would otherwise have paid. Let that land for a second. If you're a basic rate taxpayer and you put in £80, the government adds 20, turning it into 100. If you're a higher rate taxpayer, you can claim back even more, meaning every £60 out of your pocket can become £100 working for your future. That is not a return. That is an instant, guaranteed pay rise from the taxman before your money has invested a single day. And here's the genius move. Remember that horrible 60% trap between £100,000 and £125,140? A pension contribution lowers your taxable income. So if you earn just over £100,000, paying the excess into your pension or using salary sacrifice can drag you back below the line, restore your full personal allowance, and effectively give you 60% relief on that money. You're not just saving for retirement, you're dodging the single most punishing rate in the system. You can contribute up to £60,000 a year into your pension with tax relief. So for most people, there is enormous room to use this. Now let's talk about the money you make on the side, because this is where the modern Brit is leaving cash on the table. If you've got a side hustle, selling on Etsy, a bit of freelancing, flipping items online, you have what's called the trading allowance. The first £1,000 of that income is completely tax-free, and you don't even need to tell HMRC about it. And if you rent out a spare room in your home, the rent-a-room scheme lets you earn up to £7,500 a year, entirely tax-free. That's potentially over £600 a month landing in your account that the taxman never sees. Most people have no idea this even exists. And if your side income grows past that, into proper self-employment, the logic shifts again. Now you're playing the game of allowable expenses. As a self-employed worker in the gig economy, you only pay tax on your profit, not your total income. So every legitimate cost of doing business comes off the top first. The software subscriptions you use to run the business. A fair, calculated portion of your home bills, if you work from a home office. Business travel and mileage. Each of these is a perfectly legal deduction that shrinks your taxable profit and, with it, your bill. The self-employed person who tracks their expenses properly pays dramatically less than the one who shrugs and guesses. But now, a warning, because there is a villain in this story and it has been getting stronger every year. HMRC is no longer the slow, paper-shuffling office of the past. Under a program called Making Tax Digital, the taxman has become a data matching machine. It now pulls information directly from banks, from building societies, and from the online platforms you sell on. Marketplaces like eBay, Vinted, Airbnb, and the rest are now legally required to report your earnings straight to HMRC. So the old game of quietly forgetting to declare side income is over. They very likely already know. This is the crucial distinction. Everything we've talked about today is legal tax planning, using the rules as written. Hiding income is tax evasion, and the gap between the two has never been more dangerous to cross. Play the legal game, and you're untouchable. Play the other one, and the data is already pointing at you. So let's bring it home. The single biggest mistake people make is treating tax as one frantic, panicked weekend in early April, scrambling to throw money into an ISA before the deadline slams shut. But that's not how the winners do it. For them, the 5th of April isn't a deadline, it's a financial new year. Tax planning is a year-round discipline, a quiet habit, not a last-minute rush. Feed your ISA steadily, boost your pension before you hit a higher band. Track every allowable expense as it happens. Use the allowances the government is openly handing you, because the truth is simple. The tax code is not a punishment, it's a set of rules. And the people who read the rules carefully will always, legally, keep more of what they earn than the people who don't. So this year, don't work 5 months for the taxman, read the map and start working for yourself. If you learned something, make sure to like and hit subscribe. I'll see you in the next one.